And so to wrap things up, what we have here is just a brief reconciliation of the investment account, where it started with the $300,000, through all the adjustments that we made, through the profit, to the dividends, the retained earnings, the revaluation surplus, and the general reserve, and what we end up with is a closing balance of $363,000. Now, that's where we're going to leave it. We won't have any tax effects at this point in time, nor are we dealing with unrealized inventory balances, or profits on inventory, I should say. But we can see how the opening balance has moved to the closing balance through these changes. Now, let's just get rid of these. What we've effectively done may make a little bit more sense when we show what the value of the associate is over that period of time. So we made the assumption that the associate, we bought a 30% stake in it, and that was for $300,000, which would put the fair value of the acquisition, again we're making an assumption here because we don't know for sure, but if it is a reasonable assumption, at $1 million. A change to retained earnings of $120,000, that is the prior year retained earnings plus the profit this year less the dividends that were paid out. The revaluation surplus, which changed by $70,000, and the general reserve, which changed by $20,000. When you add all of these together, you end up with a closing value of the associate of $1.21 million. Now, I'll leave it for you to do, but if you take 30% of that, that should, if I've done everything correctly, which I hope I have, that should give rise to $363,000. So in effect what we've done is adjust the investment account to be 30% of the value of the associate. So the associate has done various things over time to increase its value, and we're just picking up that change in value in the investment account.